screen sharing, present it to everyone. Now we're live because I actually hit start broadcasting, opposed to earlier I didn't. So we're going to be a little bit different than audio-wise than what is going to be there. It's going to take about a 30-second delay for it to catch up. So they're just going to have to be behind because I'm going to move forward. Let's see. And that was the, you said the presentation itself was, but
the presentation looked like it was. The YouTube live wasn't.
Okay. It should be now, though.
It's coming, I guess. There it is. Yep.
And it's on this, or if you've.
It's a little bit behind.
I wouldn't worry about the volume on it, just as long as it's now going.
It's caught up.
Okay, so our YouTubers are behind a little bit, but we'll definitely make sure to add in some downloadable stuff on the website so that way they can download and see the notes that I'm going over here. So step number 2 with our building a budget here, with this, just the basics, is setting a spending plan. We know it's going to happen. You know you have to. So let's begin. When you set a spending plan, we want to know, we know that we have money to spend, but the question really should be, what money? What money are we considering? I have some that are listed here, income and expenses. And just take a quick moment and in your worksheets, write down quickly what your current expenses are and your income sources are. And when it comes to your income sources, don't include flex money or what I consider not guaranteed money. This could change your budget, and it changes the way you look at your budget. The reason I say do not include that is because it's not guaranteed. Tax refunds, bonus checks, Christmas bonuses, year-end bonuses, things like that. If you say, I'm going to include that, then you have to be prepared that if you don't get the amount that you're expecting, your expenses and or your budget's going to come crashing down. Same thing when it comes to unsecured or flex kind of money, child support, alimony, other jobs. Maybe you don't want to include, you have an extra job that you work on the weekends, you don't want to include that. Have that, put it away in a different savings account. Don't include it in your main budget. Now, while looking at all of what you get from your income and what you get and what goes out expense-wise, ask yourself, do you have everything? Is everything listed there? If not, what's missing? And the reason I ask what's missing is because sometimes individuals don't put down gas, budget for gas. They don't put down unexpected, oh, I know my tires are getting low, I'm going to have to change them. So you don't put that in, they don't put that in their plans. And then it becomes $1,000 expense out of nowhere, when in reality you could have planned for it. So even if it's like a maintenance line item on your budget, $20, $30 every month, just something to put away into that savings account so that it's that way. We have somebody there. Can you let them in, please? Thank you. So with that in mind, and when you're looking at that, there's definitely a worksheet within the booklet that I gave you that can run down income. It's the activity sheet number 4. It has your income there. Another thing that one of the, I keep saying and I'm going to get myself for it. I don't agree with the alimony and child support that it should be on there. I don't agree with certain capital gains and investments as well. Those should be what I consider extra money or bonus money. Put it away for something special. Put it away for something that you know is coming up. Maybe that's going to be where your Christmas fund. Hi, welcome. Come on in. We're in the middle, but no worries. Grab you something to eat, and You can catch along with all the worksheets we have here in front of us. Okay? Thank you, ma'am. You know, those things that are not guaranteed, they're consider them a bonuses for you, as well as anything that comes in gifts from grandma and, you know, brothers and sisters. Those things shouldn't also be considered because they're unexpected or unknown. They're not a guarantee. And same thing goes with expenses. You want to consider laundry. You want to consider your household items, things that you get from Target. You got your grocery budget that you have. Well, what about your toilet paper and your paper towels and everything else? You know, dog food, stuff like that, pet supplies. Do you have your doctor copayment listed on there as well? What about your animal? What if he gets sick and he goes to a doctor and he's needed to be there? So one of the things that, with all of those things in mind, I set this out for anyone who's attended the previous seminar that we have done or workshop that we've done regarding this, is to set yourself a savings challenge using SMART goals. This is one ways to ease into kind of getting yourself in the rhythm of having a good budget and actually saving, because one main thing that you should always consider, and when it comes to budgeting, is pay yourself first. That is one thing people forget. They say, here's my income, and then rent comes out, car payment comes out, insurance comes out, and da-da-da-da, and da-da-da-da, and there is zero bottom line. It evens out, and that's not the way it should be. You should have an item in there for you, for entertainment or just personal. You know, maybe you feel like eating out this week all week long. Well, make sure it's in there. But make sure you pay yourself first, because if not, nobody else will. So this is the saving challenge I have for everyone today, is to put away $40 per pay period into an alternate share account that only you can access once a year from your first deposit made until the next year. So for an example, I open an alternate share account and put away $80 a month. That's $40 a pay period, with the payroll deduction or a direct deposit, to begin December 1st. And so I will not withdraw those funds until December 1st of 2018. I'll add any bonus money or any extras or the savings, like the unexpected income, into there, so that way it's not a part of my daily budget. And then within the year, ideally, I have a decent amount for Christmas or a vacation of some sorts. It's also something that's that kind of gets overlooked, is an emergency fund. Emergency fund is needed and it's necessary nowadays. But with this in mind, and this savings challenge in mind, anyone who's attended and or going to be listening today online as well, I'm going to put together with the credit union to match if you want to actually partake in the savings challenge. So if you do the $80 per month and you have $200-300 at the end of the year, we'll match that. You know, payroll deduction, whatever it is that you did, up to $200. So if you are, you know, if that wants to get you to motivate you to put some extra into savings, we'll gladly do that. So we'll have more details with that coming in the next month or so. We'll send out an email to those that have attended, as well as putting with this that's online on our YouTube channel as well. So moving forward, we're now going to go into phase 1. And this is what we consider, just everything before has been a small recap of what it is to set up and start your budget. So in this one, we're going to go in here, and these are where we find our leaks, where we find our ways around our budget and making sure that it's going to work for us. And that's, with this in mind, you can either increase your income or you can decrease your expenses, because the idea is to increase your bottom line for each pay period. And that's what I had mentioned earlier, was that you don't want to zero out. So your income, if you can't increase your income, then you'll need to reduce your expenses. Sounds easy enough, right? Well, you can obtain a seasonal job or an extra shift or a weekend job. You can skip the Starbucks. You can skip the going out to Chick-fil-A for lunch or Whataburger for breakfast. And those are ways you can actually reduce your expenses without it being something like, okay, let me figure out how to minimize and make my car payment less, or let me see if I can skip a pay with someone, or maybe I need to pick up an extra shift and then I'm pushing too hard and working extra jobs elsewhere in order to find the easy things, because whether or not it'll add up, $5 or $10 here or there, it adds up quickly, and that's just extra money into a savings account. As well as a part of your spending plan or budget should be to plan for emergencies. And that's where coming in and paying yourself first, making a line item for an emergency fund is recommended. So who knows how much you should have put away in an emergency fund? I don't know. I heard something. It's 3 times your total expenses. 3 times your monthly total expenses. Everything that you pay out on a month, you should have at least 3 times that. And that was once upon a time. Nowadays, because of the job markets and the way things go, it wouldn't be unrealistic to have at least 5. If you meet with our financial advisor, Jody, she'll tell you the same thing. She wants you to have an emergency fund set up before anything else happens, because you never know when an emergency will come up. And so that's the best way to plan for one, is to have it there, because one day you can come home and your air conditioner doesn't work and it is hot outside and this is not happening because I need to go to sleep and get to work the next day. I don't have time to come in and install, much less afford a whole new AC unit, but it happens. Or you hit a curb and there goes your tire. Now you're replacing a new tire. Or worse, you get in an accident. Somebody hits you. They don't have insurance. So now you have to deal with the uninsured part and dealing with your claims and with the rental car and etc. And if you haven't prepared yourself or have certain things in place, you'll find yourself in a very hard predicament. The other thing is, it's always recommended that unexpected, and I'm going to say this over and over again throughout this presentation, because it's something that not everybody really lives by, is the unexpected sources of income. They can vary from month to month. Child support, sometimes I get it, sometimes I don't. So I don't rely on it. Bonuses, gifts, variable securities or investments, especially year-end bonuses and things like that. Your Christmas bonus. And the reason I say that, and this is revisited again, is because you could put yourself in a tough spot. You're waiting for that $1,500 Christmas bonus your boss gave you last year for the past 2 years. But this year, sales were low, and he can only afford to give you $500. So that unexpected amount that you thought you were going to pay for X, Y, and Z with is now no longer there, and you're $1,000 short. So that's the main reason why you never want to include it when it comes to your expenses. Or daily expenses. So it could be like, this job is going to pay for this specifically, then let that rotate. But otherwise, when you look at the whole picture, it's not recommended to have it in there. So my recommendation is that you take those bonus monies and you put it in a savings account and you put it away for fun. Use it to, I'm going to go on a vacation. I've been wanting to go on a vacation for I don't know how long. So any bonus, any extra tax refund that you get, throw it into that account, because it was unexpected money. It's okay to use it in that manner. But it's also that same situation. If you have an emergency, you have that money put away safely for you. So moving forward, going into expenses, the first step to making a budget work is figuring out what your expenses are. Where does your money go? Because if you don't know what your expenses are, your budget's not going to work, because you're going to forget something and then you're going to find yourself in a predicament. And that's the whole process of actually making a budget, whether it's on paper or an Excel sheet or with crayon and pencil or on a dry erase board. As long as it's written down somewhere that you can see on a daily basis. Once upon a time, we had the checked registries and we used to write them and make sure it all evened out. But nowadays, we don't use those anymore. We rely on our bank statements, our online banking, and all those lovely things to look at what's coming out of our account and stuff like that. No, we need to actually have something that we look at on a daily basis. Maybe not like OCD like me on a daily basis, but every other day or so, to make sure that all your expenses are lined up. Maybe you can adjust here or there. And then that bottom line, the income that's coming in, what's going out, that bottom line, make sure it's not zero. Make sure it's not $20. Make sure it's something decent. So that way, that's your should anything happen fund. You know that you have that sitting there. So in your expenses, reducing it's the best way to increase your bottom line. Simply because you can't just say, I want to raise and get it automatically. You can't just find a new job that's going to automatically pay you more money. So if you definitely can't increase your income, reducing your expenses is going to be the way to go. So when you look at your expenses, we're talking about fixed cost, your flex cost, or the variable expenses, and then a savings and other funds. And that savings and other funds, those are your emergency funds. That's your maintenance fund. That's your landscaping. That's your, school supplies or school clothes for the grandkids. That's your Christmas fund. Those are all those extra things that we don't really think about having it on a daily budget, but it should be. It should be a part of that daily budget because you know that that expense is essentially coming soon. So some of the things that you could include is, or I guess the question really is, what should you include? Well, everything is the answer. Gas, movie night, fast food, groceries, lunch. Even if the expenses can vary per transaction, it's a good idea to budget a set amount. And so that goes into when we're talking about our flex costs. So flex costs vary from month to month. So that can be an electricity bill. Well, for budget purposes, put $200. And so as long as your electricity bill comes in $200, well, that's extra money for you. And there are definitely ways that you can have your electricity bill under $200, regardless of how many kids you have that like to leave the lights on in every bit place and whatnot. So it's exactly that of putting a set kind of budget amount that you know that you're going to possibly spend. So that way you can prepare yourself should you get, you got an electricity bill that's $50, $60, $80, and you're like, well, I need to go ahead and move that $200 down to $100 because I'm not hitting $100. Well, then summer comes or something messed up with the AC unit, and now you're at $120. And now you're at a predicament again because you didn't leave it at $200. So the other things that would definitely want to put in is even though Chick-fil-A and like going out to eat is to die for, it's not necessary. So it's not a fixed cost. It's not a necessity. And when it comes to your budget, you should always think about what is it that I need first. And once those things have cleared, then it's, okay, what are my wants? And even at that, your wants are, I want to be able to ride around and not have any issues. So my gas budget is pretty decent. But I drive and have a heavy foot, so I need to have a decent sized gas budget. Versus someone who maybe want to stay home all day. Well, they may want to pay for their Netflix, and that's going to be their want. And so they're going to have that line item in their entertainment. So moving forward, debt to income and your budget. These are two things that usually give a lot of people problems. And so it was definitely something I wanted to touch with this presentation. Debt to income is dividing your total monthly expenses by your gross monthly income. And this is your income before taxes. The result is your debt to income ratio, which is in a form of a percentage. The lower your debt to income ratio is, the less risky you are to lenders. Now, the reason I bring this up is because this is something that is looked into when it comes to new loans and stuff like that. So you're getting your budget in great shape. Everything's looking good, credit score is going up, but your debt to income ratio is at 60%. You're not going to find a lender that's going to want to give that to you. Most lenders want to keep you under 50%. I know here at the credit union, that's the motto. And several other financial institutions, unless it's a payday lender, obviously, we don't want to put you in a predicament in which you can't afford that new payment. And so we take that new payment into consideration. Whether it's a signature loan or an auto loan, it is definitely something that, we look into. So whenever you're adding up that debt, it is exactly that, debt expenses. And so for you guys, I have a budget example here. And debt is stuff that is owed to someone with a monthly payment. So you have a debt amount, a car payment, your mortgage, your car insurance, your car payment, credit card payments. Those are all things, anything that shows up on that credit report as a debt amount owed versus what you owe. Those are what's going to be considered in that debt to income ratio. So we don't really necessarily consider electricity. We don't consider your savings. We don't consider your internet and your cell phone bill and things like that, as those can vary and you can easily say, I don't want them. But that car payment, that car loan, that signature loan, whatever else loan that it may be, credit cards, those are things that you have to pay back one way or another. They're going to get their money. So those are the ones that we look at. So on this budget here, I have a list expenses, and this budget is actually pulled from our online quizzes that we have. And the reason I bring this up is because this has given someone or some people so many problems when it comes to answering. First of all, your bottom line should never be zero when it comes to your expenses. So this budget here, they have $3,100 in expenses. They need to make more than that in order to survive, because if not, they have no room for an emergency. The budget shown, they would need to make at least or more than $6,000 to support this lifestyle. $6,000 a month. The reason for that is because this is not all the expenses one person can encounter. There's certain things that are not on here, and so we're not seeing that whole picture. The other aspect is a $6,000 income would give them a debt to income ratio of 34%. So that's realistic. That's amazing, actually. Most people are around 40 to 50% when it comes to debt to income ratio, just depending on when and how they've got their credit lines. So overall, they would also need to make over $4,100 at minimum, because then their debt to income ratio would be at that 50% based on this budget here, what we see here, and $2,000 in actual debt expenses. And so one thing I definitely want to point out with this is I've got in my budget that I pay $100 for a credit card because I don't want to make my minimum $50 payment. I want to make more. I want to hit that principal. I don't want to pay just interest every month. So when the lender is looking to calculate your debt to income ratio, we look at whatever that minimum payment is, not what you pay out. So also definitely keep that into consideration. It made it a trick question when it came to our online quiz. But also one must consider that you could pay even more than just the $100 or $150. So the things that are missing in here is the fact that electricity can increase, your insurance premiums can increase, and you can also increase your food and entertainment depending on how much you go out that week or that month, since we're looking at it on a monthly basis. So that would this actually covers 2 questions that was on that quiz of why would someone need $6,000 to support a budget like this? Because realistically, in where, you know, I guess not realistically, but more in fairyland where we want to be, a 34% debt to income ratio and being able to have way more money than what is, you know, on our monthly budget, definitely so. Because then they have something for savings already. They put away in a 401k, but they don't have an emergency fund listed on here. They don't have their car maintenance listed on here. They have their car insurance. Doesn't do anything if they get a flat tire. But all that extra is considered somewhere else. So moving forward, go into the next phase. When it comes to creating and making your budget, after you've figured out whether or not you can increase your income or decrease your expenses, pay down your debt overall to increase your bottom line. So if you have high interest credit cards or payday loans or other high interest loans, these are going to be draining your bottom line. Why? Because you're making the minimum payment and then you get extras that come on right next month. Goes away. You don't get anything, nothing hits the principal of that. So with that in mind, we're going to cover some methods that can help tackle your budget, as well as things that you might want to watch out for that are considered leeches or leaks. Consider paying off one loan or credit card and use that monthly payment once you have paid it off towards your next goal. It's called a laddering goal. So you take, say, Capital One because it's got the least, it's the highest rate, and it's a $2,000 credit limit. And that's the least of your credit cards. Well, that makes it realistic and attainable because it's not a large amount, as well as the fact it's a high interest rate. So you want to pay that off. Anything that has a high interest rate, you don't want to have to carry a balance over. You're probably paying on a $2,000 card, you're probably paying about $75 a month minimum payment. Make it $150, $100 each month, and keep chipping away. Any bonus monies, any things like that, pay it down. Once it's paid off, put it to the side. Take that $75 payment you had before and apply it to the next one. And so maybe that's Chase. Chase is a $2,500 limit. It's got a little bit lower interest rate, but it's $2,500 limit. That's going to be a little bit quicker to pay off versus my $5,000 credit card. And it gets you to a point where it makes it achievable. It's reachable. Because if you keep trying to chip away at a $5,000 credit card and it just doesn't seem to go nowhere, and you're just not getting anywhere, and you still have to use it, and so it's not going down like you want, well, then you get defeated and then you quit and you don't do it. And it just, you know what, never mind, I'm not even gonna worry about it. I'm just gonna make my payments and get on with what I'm doing. So don't set yourself up for failure, set yourself up for success when it comes to that. So plan for the unexpected. Prepare to get off track. Remember, just get right back on, because one day your kid's going to come home and be like, oh my God, Mom, I need shoes because I've ruined these. And that's going to happen right then and there. And so it happens, or you, like I said, you didn't plan for that flat tire, and now you have to, replace that tire because you don't have the insurance to cover it. So it will be a slow process. Do keep that in mind when it comes to making your budget and getting back in ahead and above water. But you should be seeing progress on a monthly basis. And that's where I say use that bonus money to make significant payments to any credit cards, loans, or things like that. Obviously, if it's a zero interest credit card or loan or whatever, then that should be the last one you want to pay off. Why? Because you're not incurring any interest. They gave you free money. Make that minimum payment every day or every month. Worry about the ones that are charging you interest. Worry about the ones that are out there that are higher. Because as soon as you get those paid down, ideally you start using them more responsibly. And so that goes into the next thing here is just you want to look at ways to be able to conquer it, not to defeat yourself, because it's all attainable. It's just having that mindset of sitting down to do it. So celebrate your progress. Don't fall off. This is the best way to do it, is to actually celebrate it. Make a plan to go out after you paid, say you paid off that credit card, whatever that SMART goal is, whatever goal it is. Treat yourself. Either go out to eat, go out on an island town, buy yourself a new little wallet. Whatever it is, something small, something simple. It's that piece of candy. Ooh, piece of candy. Ooh, piece of candy. Because if you don't, again, you get defeated and then it doesn't happen and it doesn't move forward. So in order to avoid that, if you celebrate your progress as you go, it makes it a little bit more worthwhile to continue forward, aside from the basic financial reasons. So one of the big things would be avoid incurring fees, impulse shopping, or unexpected nights out. I am definitely guilty of impulse shopping. I get bored, I sit down, I've got the computer in front of me, and I'm like, sure, why not? I know I've been needing this, and I've got a credit card with them, so let me just put that on there. I only charge as much as I can pay off the next pay period. Because if not, it's going to incur an interest, and then it's not going to, it was definitely a bad decision. But if I know that in my next pay period, I've got X amount of money, and I keep my shopping cart to that amount, then I'm good. Because I'm temporarily putting it on the credit card so that the credit card stays used, and they don't see any inactivity. It's used. But then I just paid off the next pay period, so that way I don't incur any interest or before the next cycle occurs. And this is also why you should celebrate your progress, is so that it's a planned expense. Planned impulse shopping, as funny as that sounds, plan unexpected nights out, because you can say, I'm going to put $100 away. This is going to be for just whatever, night out on the town, just because. And then when you get froggy, you can jump because you know that you put the money away already for that event. Another thing to consider is don't stop tracking your expenses. You should track everyone. And like I had mentioned earlier, we used to have a check registry where we actually wrote everything down once upon a time. And now we don't do that. We just swipe and we forget. We swipe our card, throw the receipt. Oh, don't worry about the receipt. I don't need it. And you forget. And then you overdraft because you forgot that $20 is pending because that merchant decided to take it away and it wasn't there in front of your face anymore. And then all of a sudden it magically appeared again, and now you're over. And now you've incurred a $25, if you're with us, overdraft fee. If you're not with us, probably more. So definitely, a situation of try to document those expenses, and that way you can also see what it is you actually spend within a month period. What are your normal habits? Okay, well, highlight those things. What can I take away from those habits? What can I avoid? And then calculate that amount and look at that amount and genuinely say, wow, that's a lot of money, because it probably is. I know if I skip Starbucks, that's at least $100 a month. And that's because that's just refills here or there, or buying it for somebody else. Think of those things when you're tracking it. Do it just at least for a month, just to see, and that way you like I said, visually it's attainable to you. And as I mentioned before, merchants can actually hold transactions or pin them, so it will actually look as though money is there in your account when you go to your online banking. Just for the record, that is nothing to do with the Harris County Federal Credit Union. That definitely is a merchant situation. It also varies whether or not you use your PIN versus a signature transaction. Some PIN transactions come out quicker, and that's one of the kind of the benefits of doing that, is because it would be immediately withdrawn versus a signature or a credit type transaction. Then they may pin it, and or if they have one of those where they pre-approve for like a certain amount because they know that you're going to leave a tip, and it disappears, and then it comes back and there's $30 you thought you had and you didn't have. So moving towards the end here, here's a few extra tips. And in your packets, there is a quiz, and I'm going to take this moment real quick to do it. It's activity 1. Ask yourself those questions and answer them truthfully of where you're at. And if you have way too many no's where there should be yeses, then it's definitely a consideration to use some of the tools that we have here to track where your money goes. That's activity sheet 3. Just at least for a month, track it, and that way you can visually see. The next one is activity 2 there, and it talks about short-term goals, medium-term goals, and long-term goals. Those long-term goals, that's next year's Christmas fund. That's your vacation. That's your spring break for next year. Or maybe that's, you know, that nice little Audi that you've always wanted, because that's a really big goal, and it should be a long-term, because it's not going to happen tomorrow when there's things that need to be put in place, your credit, your budget, and things that need to get in check. So your short-term goals, maybe a down payment on a new car. Let me save for that. Or maybe let me save for, like I said, I think it was earlier in the presentation, let me save for summertime. I want to take a summer trip 6 months out. Let me figure out, okay, I know this is how much it's going to cost. Let me divide that by 6 months. How much am I going to have to realistically put away? You know, break it down to the very weeks if you have to, because looking at those smaller amounts, sometimes it makes it a little bit more attainable and a little bit more realistic for you. So those extra tips, aside from the worksheets given here, are pay down your debt to reduce your monthly payments. So as I was saying earlier, for example, a $5,000 credit card, well, that has about $120. I pay $130 on that credit card. Well, if I reduce, because it's maxed out from $5,000, if I reduce that to $2,500, well, then my monthly payment is going to go down to $75 to $100. Well, I've just saved myself $20 on my bottom line budget every month. But I can also still continue to pay them $120 each month, so that every month it's more and more that gets knocked down to the principal. And also consider that with your car payments. I know that's something that some people don't consider. That's a debt like any other, and it can actually have positive equity, but you have to pay on that principal, and you have to reach that principal. So if you pay more than what your minimum monthly payment is required, you're going to be hitting principal on there. You're going to be able to get yourself in a positive equity situation. But say that's not possible, refinance it. Refinance higher interest rates, as well as search for lower rates and prices. That is with any and all. Say you have credit cards and you've got really high interest rates on those credit cards. Consider a signature loan with us. That signature loan might actually be less than what the average is on those 3. And you can take that signature loan, we pay off those 3, and then you have the 1 monthly payment with the signature loan. It's consolidation. We just don't call it that. It's something that is available, but it is an option. Consider a home equity loan, in that you pay off your debt, you fix up your house, you pay down on your car, so now you got positive equity in your home, you've got positive equity in your car, and you've got more positive equity on your bottom line each month because you pay down your debt. So another thing is to make sure that you shop around, use coupons, take advantage of discounts. We like to hold discounts a lot, so definitely consider that. Do not let charges pinned on high interest credit cards. Pay them off each cycle. So if you have 20% credit cards, make sure you're not keeping anything on those from month to month, because that's money down the drain. And that's just what we consider a leech on your budget. You want to pay more than your minimum payments, even on your car loan, so that you get positive equity when it comes time for a trade-in, or if you wanted to refinance. Say you have a car loan with a high interest rate, start paying large payments. Get it down, get it to what we consider NADA value. And then when we give you that loan, you don't have to worry about any money down. You get a lower interest rate because your credit's going to look good because you've gotten those payments down, or that debt down, and it gets you in a better position to refinance with us or with any lender for that matter. Use your new open credit lines wisely. Only charge what you can pay off in 1 to 2 payments. This is considering for 0% or low interest cards. If you, like Best Buy, they give you 12 months, 0% interest. Okay, take advantage of it. Take the entire 12 months, but make sure you know that you're going to pay whatever that amount was in those 12 months so that you do not incur any of the interest that comes with that. All right, so one of the other things I have for you is some resources. The ones that you have in front of you, as well as I'm going to take this moment right now to let our online users know, and as well as you guys, for attending the seminar today. You can receive a discount on your auto loan between now and December 31st. So if you want to refinance or if you want a new car loan, we can give you a discount on that. For YouTube and individuals that are watching online, I just need them to comment with their latest vehicle that they own, or if they have a vehicle. If they do not have a vehicle, make a comment to what they are wanting to purchase. And that will qualify them, because this YouTube video will go up for others to view later on. If they want to get a discount, they will have to make that comment on the YouTube channel. Either, the car that they currently own or a car that they're looking to buy. And that way it keeps it inconspicuous and people just think that they're talking about random auto vehicles and having conversations on other people's videos. So one of the resources I want to leave you with today is our Financial Education Center. This is not fully opened to everyone yet. So if you go to our website, if you search for it, you can find it, because I'm really good at SEO marketing. But otherwise, it's not on a drop-down menu. You're not going to be able to just readily see it. So that here should be in your pages. That financial education has 12 different modules on 12 different subjects, from being a part of a credit union to auto loans, payday loans, overdraft, checking, savings, home ownership, considering home ownership, mortgages, things like that. So take a moment, register, and explore them. I think it takes like an hour and a half to complete all 12. If you complete all 12 before December 1st, you're entered into a drawing to win $100. So there's a little bit of incentive to go and check out the financial education. Each one take a few minutes. They're not very, very hard. One of the other ones that I want you to do on there, and very specifically for this seminar and workshop, is the budget tool. It will have you walk you through making a budget. It'll ask you what your income is. It'll ask you to consider your expenses. And then it's going to make you look at what you can adjust. So it gives you kind of some visual effects for when you're considering making your budget. It's a nice little tool. You can always go back into any of the modules because you register, and so it saves your information for you. And then, of course, with our YouTube, we're going to have this on our YouTube channel to come for anyone who wants to watch it, of course, because of the discount that is going to be received for auto loans. But the other that is going to be on there, there's a few other videos that have previously we have done that are on there that are really good to consider. And then I'm fixing to upload another one regarding fraud and identity theft and stuff like that. So we're definitely a good resource for you if you're wanting to help with your finances and your budget. Here's some other ones. freeannualcreditreport.com. You can go and get your credit report once a year for free. from all three of them, Equifax, Experian, and TransUnion. I will say this, that you can go to each one of them as well on your own and request. I personally use Equifax, and I know Equifax was in the news for their breach and stuff like that. They give you alerts. They've sent me an email just 2 weeks ago saying no news is good news. Your name has not been pulled in any data from online, so you should be in the clear and not have to worry. But of course, we'll keep monitoring it for you. But with Equifax, I paid $20 a month and I can get my score updated, unlimited, anytime I want at the push of a button. And so what I do is I make large payments to my credit cards, and I know those cycles end on the 16th. So around the 20th, I'll go and check my Equifax and see how it affected my credit score. So that's some of the ways, and you can use these tools to kind of help you, especially if you're looking to purchase something in the upcoming. You want to know what you want to walk in there wherever it is and know that, well, I know my credit score is this, and I know this much, and I know my debt to income ratio is here. So what can you do for me? And the best way to do that is to be prepared and basically be the person who knows what's going on. Here's two other ones, energyogre.com and choosetosave.org. These are two sources that you can actually reduce your electricity bill and or utility bills. I personally use Energy Ogre, and we paid $50 this last month for our electricity bill. And that's running the air conditioner and cameras and lights and all kinds of things throughout the day, and just not really caring. You know, once upon a time where mom would scream, close the door because you're air conditioning the neighborhood. So those are some extras to kind of give you and let you be able to, like I said, reduce your expenses in order to save. So start small, start short, but be committed. Because as long as you're committed, then it's going to work. And if it's going to work, you're going to see the progress, and it's going to benefit you in the end. And HCFCU is always here to help. I'm Pauline. I'm with marketing. I'm the one who created this presentation. I'm a phone call away. If you want to sit down one day, I'm more than happy to set an appointment with you. Another thing that we do have now is a financial advisor, Jody Smith. She's with Members Financial Services. She is the one I had mentioned earlier who will, if you sit down with her for wealth management or money management or just planning in general, say you got kids going to college soon, you know, or you're looking for retirement and you want to talk about retirement, she's the person to contact. Her information is on our website. And we do have an array of online resources as well on our webpage under other resources. Is there any questions or anything that maybe I didn't cover or you wanted to consider? No? Okay. All righty. That's it. Let me make sure I stop the live stream. Bye, guys.